Welcome into another daily editorial here on the KE Report. In this daily editorial, I am joined by Jordan Roy-Byrne, the founder and editor of thedailygold.com. And Jordan, we are going to look at some of the precious metals charts as well as some of the ETFs that look at and hold the stocks. But first, you came out with an interesting article on your site that talks about interest rates and what it would take in terms of interest rate moves for gold to actually benefit. We need to understand that over the past, now 2 months, we've been in a rising interest rate environment as judged by either the 2-year or the 10-year. The 10-year bottomed just above 2% back in early September and currently is trading at about 2.35%. So again, still not a major breakout by any sense, but it did start trading at a range when it did reach just above 2.4% that we hadn't seen since back in March of this year. So again, we are in, let's say, a general uptrend, at least short term, for interest rates, both the 2-year and the 10-year, pretty much across the board. But in your eyes, what would help gold in this sense? Because usually when we hear of rising interest rates, that's usually negative for gold.
Yeah, Corey, rising interest rates are negative for gold. It's generally the case unless you have a rise in inflation expectations. And if you're looking at real interest rates, then you need inflation to rise faster than short-term rates or the Fed funds rate. And at the same time, when you're looking at interest rates specifically, we would need long-term rates to rise faster than short-term rates for that scenario to be bullish for gold. So just looking at the yield curve and the 10-year and the 2-year yield, if we look in the last few years, I mean, gold in shorter term periods has been negatively correlated to rising rates. So every time we see a trend lower in rates, gold has been doing well. Rates surged from the middle of 2016 to the end of the year, and of course, gold sold off. I mean, almost 200, actually more than $200, about $250 from 1375 down to 1125-ish. And I mean, the reason why that's negative for gold, at least now, is because inflation, while going up a little bit, inflation expectations, while going up a little bit, they're not going up fast enough for gold to move higher. We need to see like a real strong increase in inflation. It has to be going up faster than short-term rates. And same thing again with, you can use the 10-year yield as a proxy for long-term rates. We want to see the yield curve steepening, so we want to see the 10-year rising much faster than the 2-year. Alternatively, the other scenario, which really helped gold in the 2000s, was the 2 times when the yield curve was steepening, we saw a real plunge in short-term rates. And so in that scenario, if short-term rates are plunging faster than long-term rates, that's also bullish for gold. So we need one of those things to happen. And like you said at the beginning, interest rates have been going up, both short and long-term rates. I mean, if you look at the 10-year in the last couple of months, I mean, it's gone from roughly 2.04% up to almost 2.5% recently. And if you look at a 5 or 10-year chart of the 10-year, you can see that there's important resistance at 2.60 and then around 3%. So the issue is if this rising rate environment continues, if the 10-year goes above 2.60, I mean, is that going to be bullish or bearish for gold? I'd probably say it's bearish. I could be wrong, but I'd say if we're going to continue to see rising rates well into next year, then we might need to see the 10-year get above 3% for that to actually be bullish for gold. But just reaching 2.60 and then going above 2.60 to 3, that might not be bullish for gold. You might need to see it really have a big break above 3% in the rising rate scenario for that to be bullish for gold. So I mean, I know this can get kind of complicated, but that explains right now at least why rising rates are not bullish for gold. And I mean, the 2-year, of course, which you said is about 1.60%. I mean, that's been rising very fast recently. And so if that's rising very fast, then we need to see the 10-year and inflation start to rise even faster for that to benefit gold.
And that, I think, is what some people are waiting for, and I know even the Fed and other market commentators would like to see a steepening of that yield curve, which would mean the long end go up, well, much faster than it has been, especially compared to the short end, the 2-year. But again, this is, I think, showing maybe the change in policy from some of the central banks, especially the Fed, that with taking away raising interest rates and slowly unwinding their balance sheet, I think they're hoping that that can increase the long end. But again, we just haven't seen the long end skyrocketing. Plus, as you said, these inflation expectations and inflation data have been picking up, but they're not screaming higher. So when you take into context these gradual moves that we're seeing both on policy level and on market level, it really has to make you think that gold could again be stuck in this range it's been in, failing to break out, failing to break down, still for at least a number of months. Is that the way you're carrying this over, Jordan?
Yeah, that's a very good point. Although I'm always cautious about gold, but I would be cautious to say, well, I mean, I guess it depends on what level you're talking about, but if you're looking at, transitioning and talking about the technicals of gold looks like it's made a mini bottom here in the low 1260s. I know it's up today, but if you look at the miners, they've already broken below their October lows, while gold has not. And so that's a bad sign, even though gold is not even that far from 1300. If you would look at the action in the miners, that's hinting of gold probably trading in the low 1200s. 1200 or 1220, there's important support there. And so the miners just badly underperforming gold in recent weeks is just a negative sign for the sector. That's telling us that gold probably over the next month or two is much more likely to go lower than higher from here.
Yeah, unfortunately, the stocks, especially if you look at GDX and GDXJ, their failure to break to new highs just for this year, when we did see that run that petered off in the beginning of September, that was a disappointment to me. But the one thing that I want you to comment on is that we seem to get these consistent bottoms. For GDX, it seems to be right around 21, and for gold, it seems to be, at least for this year, right around that $1,200 level. As you said, 1,200 to 1,220. As long as we hold these levels and, who knows, potentially put in slightly higher highs, that has to be encouraging, doesn't it?
Yeah, it would be really encouraging if GDX would hold 21, but to me, it honestly doesn't make that big of a difference. If you're looking, same thing with gold. If you're looking at like a 5 or a 6-year chart, we have this massive bottoming pattern, and so it really, in the very big picture, it really doesn't make that much of a difference if the next low in GDX is 21 or 18. Of course, we're following it day to day, week to week, and that would be a big difference for a lot of juniors. But just in the very big 5 to 6 year time frame, when you're looking at that kind of a chart, it's really not that big of a difference. But that being said, GDX is already at 22.6, so 21 is not that much further down. We have to see how things turn out, but I think looking at GDX and GDXJ that we're probably more likely than not to see a retest of the December 2016 lows, which are about 18 for GDX and 27, 28 for GDXJ. So, we need a little more sell-off to get GDX down to 21, but then when it gets down there, if it does, we'll just have to evaluate how everything looks. How's sentiment looking? How's the trading action? Is breadth starting to improve? Are the miners starting to lead gold? Those are the things we look at when the miners get down to certain support targets. But, in the meantime, Corey, it's just a waiting game. It's a boring market. As we've said many times, we've seen a sell-off in GDX and GDXJ, and they're very oversold in a short-term sense, and they've kind of been rallying and stabilizing in recent days. And I would probably look for that action to continue for another week, but it's really not that impressive. We're just kind of working off that oversold condition, and after another week or two, maybe the miners could be ready to turn lower again, and for GDX test 21, as you said.
So, Jordan, what about an outlook for next year? I think we both agree that the remainder of this year will be fairly tough and fairly slow for the metals. Maybe, who knows, a black swan event or something crazy could happen that pops gold. But right now, it seems like we both agree that a slow next couple months. What's your outlook for 2018? Do you think in the early part of the year it could get going, or it's going to outstretch this slow market that we've been in really since the beginning of the year?
Yeah, I mean, I think what I have been thinking is that we're probably going to see an important low after the Fed hike. But the question is, I mean, is that going to be the low point where we have a good rally and the rally just keeps going, or it's just a rally and it peters out again? So I'm not really sure if the next low is going to be December, or if we might see another low sometime in Q1 or Q2. It's just really hard for me to say, honestly, because it depends so much on, I mean, are we going to see Are we going to see a real surge in inflation next year? Are we going to see the CPI get above 3%? I mean, that would be very bullish for gold. Are we going to, or are we going to see, the economy, the yield curve get inverted, and the economy, there'd be real fears of recession? That would also be bullish for gold. But if we're just going to stay in this middle range, that's not good for gold, and gold would continue to stay range bound. So it's very hard for me to forecast the year, but I think if we have the right fundamental developments, we'll probably see an important low at some point early in the year, and then we could see a move to potentially challenge the 2016 highs. But overall, I mean, it's so hard to forecast. I'm just focused on trying to buy good companies the next time this sector looks like it's very oversold again. So, I mean, if we get in GDXJ, if we get down to that 27, 28 December 2016 low, I mean, that's probably going to be a reasonable entry point, regardless of if the sector is going to break out in 2018 or not. Because if you buy those types of lows, then you're probably going to do well, at least in the near term, and it protects you in the long run if the market's not going to break out and it continues to consolidate. So I know that was a lot to take on, but we definitely have the technical setup to have a major breakout in 2018, but it's so early to say if we're going to get that breakout. I mean, maybe we make an important low and we finish next year strong, but we don't break out, and then maybe the breakout's in early 2019. I don't know. I mean, I'm generally positive in the long term, but I'm not, forecasting like an imminent breakout at this point. It's just so hard to tell.
Okay, I totally understand what you're saying there, Jordan, and quite frankly, it seems like we might be stuck in this environment for a little bit longer, and if we do see almost a washout come into GDXJ and GDX down to those lows that we hit in December of last year, then take that as a buying opportunity. One thing to also consider is that at this time last year, GDX is trading right around the same level that it is trading at now. So first week of November was pretty rough, and it continued down till almost the end of the year. We have the same rate hike expectations and some similar economic data coming out. So, hey, that might be in the cards. But again, still longer term encouraged. But if you're a day trader in this market, man, it can be very, very frustrating. Jordan, hey, man, thanks for your time today.